Don't allow a winner's game to become a loser's game. Let's start from the beginning. What is an index fund? It is simply a basket, portfolio, that holds many eggs, stocks, designed to mimic the overall performance of any financial market or market sector. Footnote: please keep in mind that an index may also be constructed around bonds in the bond market, or even road less traveled asset classes such as commodities or real estate. Today, if you wish, you could literally hold all of your wealth in a diversified set of index funds representing asset classes within the U.S. or the global economy. Classic index funds, by definition, basically represent the entire stock market basket, not just a few scattered eggs. Such index funds eliminate the risk of individual stocks, the risk of market sectors, and the risk of manager selection, with only stock market risk remaining, which is quite large enough, thank you. Index funds make up for their lack of excitement by their truly remarkable long-term productivity. This is much more than a book about index funds. It is a book that is determined to change the very way that you think about investing. For when you understand how our financial markets actually work, you will see that the index fund is indeed the only investment that guarantees that you will capture your fair share of the returns that American business earns. Thanks to the miracle of compounding, the accumulations of wealth over the years generated by those returns have been little short of fantastic. I'm speaking here about the classic index fund, one that is broadly diversified, holding all or almost all of its share of the $15 trillion capitalization of the U.S. stock market, operating with minimal expenses and without advisory fees, with tiny portfolio turnover, and with high tax efficiency. The index fund simply owns corporate America, buying an interest in each stock in the stock market in proportion to its market capitalization and then holding it forever. Please don't underestimate the power of compounding the generous returns earned by our businesses. Over the past century, our corporations have earned a return on their capital of 9.5% per year. Compounded at that rate over a decade, each $1 initially invested grows to $2.48. Over 2 decades, $6.14. Over 3 decades, $15.22. Over 4 decades, $37.72. And over 5 decades, $93.48. Footnote: these accumulations are measured in nominal dollars, with no adjustment for the long-term decline in their buying power, averaging about 3% a year since the 20th century began. If we use real inflation-adjusted dollars, the return drops from 9.5% to 6.5%. As a result, the accumulations of an initial investment of $1 would be $1.88, $3.52, $6.61, $12.42, and $23.31 for respective periods. The magic of compounding is little short of a miracle. Simply put, thanks to the growth, productivity, resourcefulness, and innovation of our corporations, capitalism creates wealth, a positive-sum game for its owners. Investing in equities is a winner's game. The returns earned by business are ultimately translated into the returns earned by the stock market itself. I have no way of knowing what share of these returns you have earned in the past, but academic studies suggest that if you are a typical investor in individual stocks, your returns have probably lagged the market by about 2.5 percentage points per year. Applying that figure to the annual return of 12% earned over the past 25 years by the Standard & Poor's 500 stock index, your annual return has been less than 10%. Result: your slice of the market pie, as it were, has been less than 80%. To make matters worse, as you will see in Chapter 5, if you are a typical investor in mutual funds, you've done even worse. If you don't believe that is what most investors experience, think for a moment, please, about the relentless rules of humble arithmetic. These iron rules define the game. As investors, all of us as a group earn the stock market's return. As a group, I hope you're sitting down for this astonishing revelation, we are average. Each extra return that one of us earns means that another of our fellow investors suffers a return shortfall of precisely the same dimension. Before the deduction of the cost of investing, beating the stock market is a zero-sum game. But the costs of playing the investment game both reduce the gains of the winners and increases the losses of the losers. So who wins? You know who wins. The man in the middle. Actually, the men and women in the middle. The brokers, the investment bankers, the money managers, the marketers, the lawyers, the accountants, the operations departments of our financial system is the only sure winner in the game of investing. Our financial croupiers always win. In the casino, the house always wins. In horse racing, the track always wins. In the trifecta lottery, the state always wins. Investing is no different. After the deduction of the cost of investing, beating the stock market is a loser's game. Don't allow a winner's game to become a loser's game. Yes, after the costs of financial intermediation, all those brokerage commissions, portfolio transaction costs, and fund operating expenses, all those investment management fees, all those advertising dollars, and all those marketing schemes, and all those legal costs and custodial fees that we pay day after day and year after year, beating the market is inevitably a game for losers. No matter how many books are published and promoted purporting to show how easy it is to win, investors fall short. Indeed, when we add the cost of these self-help investment books into the equation, it becomes even more of a loser's game. The wonderful magic of compounding that is reflected in the long-term returns earned by American business, then, is translated into equally wonderful returns in the stock market. But those returns are overwhelmed by the powerful tyranny of compounding the costs of investing. For those who choose to play the game, the odds in favor of the successful achievement of superior returns are terrible. Simply playing the game consigns the average investor to a woeful shortfall to the returns generated by the stock market over the long term. Most investors in stocks, of course, think that they can avoid the pitfalls of investing by due diligence and knowledge, trading stocks with alacrity in order to stay one step ahead of the game. But the fact is that while the investors who trade the least have a fighting chance of capturing the market's return, those who trade the most are doomed to failure. For example, an academic study showed that the most active 1/5 of all stock traders turn their portfolios over at the rate of more than 21% per month. While they earned the market return of 17.9% per year during the period 1990 to 1996, they incurred trading costs of about 6.5%. Leaving them with an annual return of but 11.4%, only 2/3 of the return in that strong market upsurge. Mutual fund investors, too, have inflated ideas of their own omniscience. They pick funds based on the recent performance superiority of fund managers, or even their long-term superiority, and hire advisors to help them do the same thing. But the advisors do it with even less success. See chapters 8, 9, and 10. Oblivious of the toll taken by costs, fund investors willingly pay heavy sales loads and incur excessive fund fees and expenses, and are unknowingly subjected to the substantial but hidden transaction costs incurred by funds as a result of their hyperactive portfolio turnover. Fund investors are confident that they can easily select superior fund managers. They are wrong. Contrarily, for those who invest and then drop out of the game, and never pay a single unnecessary cost, the odds in favor of success are awesome. Why? Simply because they own businesses. And businesses as a group earn substantial returns on their capital and pay out dividends to their owners. Yes, many individual companies fail. Firms with flawed ideas and rigid strategies and weak managements ultimately fall victim to the creative destruction that is the hallmark of competitive capitalism. The formulation of Joseph E. Schumpeter in Capitalism, Socialism, and Democracy, 1942. But in the aggregate, businesses grow with the long-term growth of our vibrant economy. This book will tell you why you should stop contributing to the croupiers of the financial markets, who rake in something like $400 billion each year from you and your fellow investors. It will also tell you how easy it is to do just that. Simply buy the entire stock market. Then, once you've bought your stocks, get out of the casino and stay out. Just hold the market portfolio forever. And that's what the index fund does. This investment philosophy is not only simple and elegant, the arithmetic on which it is based is irrefutable. But so long as investors accept the status quo of today's crazy quilt financial market system, so long as they enjoy the excitement, however costly, of buying and selling stocks, so long as they fail to realize that there is a better way, such a philosophy will seem counterintuitive. But I ask you to carefully consider the impassioned message of this little book. When you do, you too will want to join the revolution and invest in a new, more economical, more efficient, even more honest way, a more productive way, a way that will put your own interest first. It may seem far-fetched for me to hope that any single little book could ignite the spark of a revolution in investing. New ideas that fly in the face of the conventional wisdom of the day are always greeted with doubt, scorn, and even fear. Indeed, 230 years ago, the same challenge was faced by Thomas Paine, whose 1776 tract, Common Sense, helped spark the American Revolution. Here is what Tom Paine wrote. Perhaps the sentiments contained in the following pages are not yet sufficiently fashionable to procure them general favor. A long habit of not thinking a thing wrong gives it a superficial appearance of being right, and raises at first a formidable outcry in defense of custom. But the tumult soon subsides. Time makes more converts than reason. In the following pages, I offer nothing more than simple facts, plain arguments, and common sense, and have no other preliminaries to settle with the reader than that he will divest himself of prejudice and prepossession, and suffer his reason and his feelings to determine for themselves that he will put on, or rather that he will not put off, the true character of a man, and generously enlarge his views beyond the present day. As we now know, Thomas Paine's powerful and articulate arguments carried the day. The American Revolution led to our Constitution, which to this day defines the responsibility of our government, our citizens, and the fabric of our society. Inspired by his words, I titled my 1999 book, Common Sense on Mutual Funds, and asked investors to divest themselves of prejudice and to generously enlarge their views beyond the present day. In this new book, I reiterate that proposition. In Common Sense on Mutual Funds, I also applied to my idealistic self these words of the late journalist Michael Kelly. The driving dream of the idealist is that if he could only explain things to enough people, carefully enough, thoroughly enough, thoughtfully enough, why eventually everyone would see, and then everything would be fixed. This book is my attempt to explain the financial system to as many of you who will listen, carefully enough, thoroughly enough, and thoughtfully enough, so that you will see and it will be fixed, or at least that your own participation in it will be fixed. Some may suggest that, as the creator both of Vanguard in 1974 and of the world's first index mutual fund in 1975, I have a vested interest in persuading you of my views. Well, of course I do. But not because it enriches me to do so. It doesn't earn me a penny. Rather, I want to persuade you because the very elements that formed Vanguard's foundation all those years ago, all those values and structures and strategies, will enrich you. In the early years of indexing, my voice was a lonely one. But there were a few other thoughtful and respected believers whose ideas inspired me to carry on my mission. Today, many of the wisest and most successful investors endorse the index fund concept, and among academics, the acceptance is close to universal. But don't take my word for it. Listen to these independent experts with no axe to grind except for the truth about investing. You'll hear from some of them at the end of each chapter. Listen, for example, to this endorsement by Paul A. Samuelson, Nobel laureate and professor of economics at Massachusetts Institute of Technology, to whom this book is dedicated. Bogle's reasoned precepts can enable a few million of us savers to become in 20 years the envy of our suburban neighbors, while at the same time we have slept well in these eventful times. The financial system itself, alas, won't be fixed for a long time. But the glacial nature of that change doesn't prevent you from looking after your own self-interest. You don't need to participate in its expensive foolishness. If you choose to play the winner's game of owning businesses, and refrain from playing the loser's game of trying to beat the market, you can begin the task simply by using your own common sense, understanding the system, and investing in accordance with the only principles that will eliminate substantially all of its excessive costs. Then at last, whatever returns our businesses may be generous enough to deliver in the years ahead, reflected as they will be in our stock and bond markets, you will be guaranteed to earn your fair share. John C. Bogle, Valley Forge, Pennsylvania, October 20th, 2006. Don't take my word for it. Charles T. Munger, Warren Buffett's partner at Berkshire Hathaway, puts it this way: the general systems of money management today require people to pretend to do something they can't do and like something they don't. It's a funny business because on a net basis, the whole investment management business together gives no value added to all buyers combined. That's the way it has to work. Mutual funds charge 2% per year, and then brokers switch people between funds, costing another 3 to 4 percentage points. The poor guy in the general public is getting a terrible product from the professionals. I think it's disgusting. It's much better to be part of a system that delivers value to the people who buy the product. William Bernstein, investment advisor and neurologist, and author of The 4 Pillars of Investing, says, "It's bad enough that you have to take market risk. Only a fool takes on the additional risk of doing yet more damage by failing to diversify properly with his or her nest egg. Avoid the problem. Buy a well-run index fund and own the whole market." Here's how The Economist of London puts it: the truth is that, for the most part, fund managers have offered extremely poor value for money. Their records of outperformance are almost always followed by stretches of underperformance. Over long periods of time, hardly any fund managers have beaten the market averages. They encourage investors, rather than spread their risks wisely or seek the best match for their future liabilities, to put their money into the most modish assets going, often just when they become overvalued. And all the while they charge their clients big fees for the privilege of losing their money. One specific lesson is the merits of indexed investing. You will almost never find a fund manager who can repeatedly beat the market. It is better to invest in an indexed fund that promises a market return, but with significantly lower fees. Chapter 1. A Parable with a Moral. The Gottschalk Family. Even before you think about index funds, in their most basic form, mutual funds that simply buy all of the stocks in the U.S. stock market and hold them forever, you must understand how the stock market actually works. Perhaps this homely parable, my version of a story told by Warren Buffett, chairman of Berkshire Hathaway Incorporated, in the firm's 2005 annual report, will help clarify the foolishness and counterproductivity of our vast and complex financial market system. Once upon a time, a wealthy family named the Gottschalks, grown over the generations to include thousands of brothers, sisters, aunts, uncles, and cousins, owned 100% of every stock in America. Each year, they reaped the rewards of investing, all of the earnings growth that those thousands of corporations generated, and all of the dividends that they distributed. To complicate matters just a bit, the Gottschalks family, of course, also purchased the new public offerings of securities that were issued each year. Each family member grew wealthier at the same pace, and all was harmonious. Their investment had compounded over the decades, creating enormous wealth, for the Gottschalks family was playing a winner's game. But after a while, a few fast-talking helpers persuade some of the Gottschalks' cousins that they can earn a larger share than the other relatives. These helpers convince the cousins to sell some of their shares in the companies to other family members and to buy some shares of others from them in return. The helpers handle the transactions and, as brokers, receive commissions for their services. The ownership is thus rearranged among the family members. To their surprise, however, the family wealth begins to grow at a slower pace. Why? Because the family share of that generous pie that American industry bakes each year, all those dividends paid, all those earnings reinvested in the business, 100% at the outset, starts to decline, simply because some of the return is now consumed by the helpers. To make matters worse, while the family had always paid taxes on their dividends, some of the members are now also paying taxes on the capital gains they realized from their stock swapping back and forth, further diminishing the family's total wealth. The smart cousins quickly realize that their plan has actually diminished the rate of growth in the family's wealth. They recognize that their foray into stock picking has been a failure and conclude that they need professional assistance, the better to pick the right stocks for themselves. So they hire stock picking experts, more helpers, to gain an advantage. These money managers charge a fee for their services. So when the family appraises its wealth a year later, it finds that its share of the pie has diminished even further. To make matters still worse, the new managers feel the compulsion to earn their keep by trading the family's stocks at feverish levels of activity, not only increasing the brokerage commissions paid to the first set of helpers, but running up the tax bill as well. Now the family's earlier 100% share of the dividend and earnings pie is even further diminished. Well, we failed to pick good stocks for ourselves, and when that didn't work, we also failed to pick managers who could do so, the smart cousins say. What shall we do? Undeterred by their two previous failures, they decide to hire still more helpers. They retain the best investment consultants and financial planners they can find to advise them on how to select the right managers, who will then surely pick the right stocks. The consultants, of course, tell them that they can do exactly that. Just pay us a fee for our services, the new helpers assure the cousins, and all will be well. Alas, the family share of the pie tumbles once again. Alarmed at last, the family sits down together and takes stock of the events that have transpired since some of them began to try to outsmart the others. How is it, they ask, that our original 100% share of the pie, made up each year of all of those dividends and earnings, has dwindled to just 60%? Their wisest member, a sage old uncle, softly responds, "All that money you've paid to those helpers and all those unnecessary extra taxes you're paying come directly out of our family's total earnings and dividends. Go back to square one and do so immediately. Get rid of all your brokers. Get rid of all your money managers. Get rid of all your consultants. Then our family will again reap 100% of however large a pie that corporate America bakes for us year after year." They did exactly that, returning to their original passive but productive strategy, holding all of the stocks of corporate America and standing pat, exactly what an index fund does. And the Gottrocks family lived happily ever after. Adding a fourth law to Sir Isaac Newton's three laws of motion, the inimitable Warren Buffett puts the moral of the story this way: for investors as a whole, returns decrease as motion increases. Accurate as that cryptic statement is, I'd add that the parable reflects the profound conflict of interest between those who work in the investment business and those who invest in stocks and bonds. The way to wealth for those in the business is to persuade their clients, don't just stand there, do something. But the way to wealth for their clients in the aggregate is to follow the opposite maxim. Don't do something, just stand there. For that is the only way to avoid playing the loser's game of trying to beat the market. When any business is conducted in a way that directly defies the interests of its clients in the aggregate, it is only a matter of time until change comes. The moral of the story, then, is that successful investing is about owning businesses and reaping the huge rewards provided by the dividends and earnings growth of our nation's corporations. The higher the level of their investment activity, the greater the cost of financial intermediation and taxes, the less the net return that the business owners as a group receive. The lower the cost that investors as a group incur, the higher rewards that they reap. So to realize the winning returns generated by American business over the long term, the intelligent investor will minimize to the bare bones the costs of financial intermediation. That's what indexing is all about, and that's what this book is all about. Don't take my word for it. Listen to Jack R. Meyer, former president of Harvard Management Company, the remarkably successful wizard who tripled the Harvard Endowment Fund from $8 billion to $27 billion. Here's what he had to say in a Business Week interview. The investment business is a giant scam. Most people think they can find managers who can outperform, but most people are wrong. I will say that 85 to 90% of managers fail to match their benchmarks. Because managers have fees and incur transaction costs, you know that in the aggregate, they are deleting value. When asked if private investors can draw any lessons from what Harvard does, Mr. Meyer responded, yes. First, get diversified. Come up with a portfolio that covers a lot of asset classes. Second, you want to keep your fees low. That means avoiding the most hyped but expensive funds in favor of low-cost index funds. And finally, invest for the long term. Investors should simply have index funds to keep their fees low and their taxes down. No doubt about it. In terms that are a bit more academic, Princeton professor Burton G. Malkiel, author of A Random Walk Down Wall Street, expresses these views. Index funds have regularly produced rates of return exceeding those of active managers by close to 2 percentage points. There are two fundamental reasons for this excess performance: management fees and trading costs. Public index funds are typically run at a fee of less than 0.2%. Actively managed public mutual funds charge annual management and market expenses that on average are 150 basis points, 1.5 percentage points per year. Moreover, index funds trade only when necessary, whereas active funds typically have a turnover rate close to 100%, and often even more, with trading costs of at least another 0.5 to 1% of performance a year, and probably a lot more. Active management as a whole cannot achieve gross returns exceeding the market as a whole, and therefore they must, on average, underperform the indexes by the amount of these expense and transaction cost disadvantages. Experience conclusively shows that index fund buyers are likely to obtain results exceeding those of the typical fund manager, whose large advisory fees and substantial portfolio turnover tend to reduce investment yields. Many people will find the guarantee of playing the stock market game at par every round a very attractive one. The index fund is a sensible, serviceable method for obtaining the market's rate of return with absolutely no effort and minimal expense. Chapter 2. Business reality trumps market expectations. Here begins the first lesson. That wonderful opening parable brings home the central reality of investing. The most that owners in the aggregate can earn between now and Judgment Day is what their business in the aggregate earns, in the words of Warren Buffett. Illustrating the point with Berkshire Hathaway, the publicly owned investment company he has run for 40 years, Buffett says, when the stock temporarily overperforms or underperforms the business, a limited number of shareholders, either sellers or buyers, receive outsized benefits at the expense of those they trade with. But over time, the aggregate gains made by Berkshire shareholders must of necessity match the business gains of the company. How often investors lose sight of that eternal principle, yet the record is crystal clear. History, if only we would take the trouble to look at it, reveals the remarkable, if essential, linkage between the cumulative long-term returns earned by American business, the annual dividend yield, plus the annual rate of earnings growth, and the cumulative returns earned by the U.S. stock market itself. Need proof? Just look at the record since the 20th century began. The average annual total return on stocks was 9.6%, virtually identical to the investment return of 9.5%, 4.5% from dividend yield, and 5% from earnings growth. That tiny difference of 0.1% per year arose from what I call speculative return, depending on how one looks at it, perhaps merely statistical noise, or perhaps from a generally upward long-term trend in stock valuations, reflecting the willingness of investors to pay higher prices for each dollar of earnings at the end of the period than at the beginning. Compounding these returns over 106 years produced accumulations that are truly staggering. Each dollar initially invested in 1900 at an investment return of 9.5% grows by the close of 2005 to $14,808. Sure, few, if any of us have 106 years in us, but like the Gottschalks family over the generations, the miracle of compounding returns is little short of amazing, perhaps the ultimate winner's game. Footnote. But let's be fair. If we compounded that initial $1, not at the nominal return of 9.5%, but at the real, after inflation rate of 6.5%, the accumulation grows to $793. But increasing real wealth nearly 8 times over is not to be sneezed at. Yes, there are bumps along the way in the investment returns earned by our business corporations. Sometimes, as in the Great Depression of the early 1930s, these bumps are large. But we get over them. So, if you stand back and squint your eyes, the trend of business fundamentals looks almost like a straight line sloping gently upward, and those periodic bumps are barely visible. Note, however, that stock market returns sometimes get well ahead of business fundamentals. The late 1920s, the early 1970s, the late 1990s. But it has been only a matter of time until, as if drawn by a magnet, they soon return, although often only after falling well behind for a time. The mid-1940s, the late 1970s, the 2003 market lows. In our foolish focus on the short-term stock market distractions of the moment, we too often overlook this long history. We ignore the fact that when the returns on stocks depart materially from the long-term norm, it is rarely because of the economics of investing, the earnings growth and dividend yields of America's corporations. Rather, the reason that annual stock returns are so volatile is largely because of the emotions of investing. We can measure these emotions by the price-earnings ratio, which measures the number of dollars investors are willing to pay for each dollar of earnings. As investor confidence waxes and wanes, P/E multiples rise and fall. Changes in interest rates also have an impact, uneven though it may be, on the P/E multiple, so I'm oversimplifying a bit here. When greed holds sway, we see very high P/Es. When hope prevails, moderate P/Es. When fear is in the saddle, P/Es are very low. Back and forth, over and over again, swings in the emotions of investors momentarily derail the long-range upward trend in the economics of investing. While the prices we pay for stocks often lose touch with the reality of corporate values, in the long run, it is reality that rules. So while investors seem to intuitively accept the idea that the past is inevitably prologue to the future, any past stock market returns that have included a high speculative stock return component are deeply flawed as a guide to what now lies ahead. To understand why past returns do not foretell the future, we need only heed the words of the great British economist John Maynard Keynes, written 70 years ago. It is dangerous to apply to the future inductive arguments based on past experience, unless one can distinguish the broad reasons why past experience was what it was. But if we can distinguish the reasons why the past was what it was, then we can establish reasonable expectations about the future. Keynes helped us make this distinction by pointing out that the state of long-term expectation for stocks is a combination of enterprise, forecasting the prospective yield of assets over their whole life, and speculation, forecasting the psychology of the market. Chapter 12 of the General Theory of Employment, Interest, and Money, John Maynard Keynes, 1936. I'm well familiar with those words, for 55 years ago I incorporated them in my senior thesis at Princeton, written, providentially for my lifetime career that followed, on the economic role of the investment company, the title I chose for the thesis. This dual nature of returns is clearly reflected when we look at stock market returns over the decades. Using Keynes' idea, I divide stock market returns into 1. Investment return, enterprise, consisting of the initial dividend yield on stocks plus their subsequent earnings growth, together the essence of what we call intrinsic value, and 2. Speculative return, the impact of changing price-earnings multiples on stock prices. Let's start with the average annual returns on stocks over the decades since 1900. The steady contribution of dividend yields to total return during each decade is always positive, only once outside the range of 3% to 7%, and averaging 4.5%. The contribution of earnings growth to investment return, with the exception of the depression-ridden 1930s, was positive in every decade, usually running between 4% and 7%, and averaging 5% per year. Result? Total investment returns, which combine dividend yield and earnings growth, were negative in only a single decade, again the 1930s. These total investment returns, the gains made by business, were remarkably steady, generally running in the range of 8% to 13% per year, and averaging 9.5%. Enter speculative return. Compared with the relative consistency of dividends and earnings growth over the decades, truly wild variations in speculative return occur as price-earnings ratios, PEs, wax and wane. A 100% rise in the PE from 10 to 20 times over a decade, for example, would equate to a 7.2% annual speculative return. Curiously, without exception, every decade of significantly negative speculative return was immediately followed by a decade in which it turned positive by a correlative amount. The quiet 1910s, and then the roaring 1920s, the dispiriting 1940s, and then the booming 1950s, the discouraging 1970s, and then the soaring 1980s. Reversion to the mean, RTM, writ large. Then, amazingly, we see an unprecedented second consecutive exuberant increase in speculative return in the 1990s, a pattern never before in evidence. By the close of 1999, the PE rate had risen to an unprecedented level of 32 times, setting the stage for the return to sanity in valuations that soon followed. The tumble in stock market prices gave us our comeuppance. With earnings continuing to rise, the PE currently stands at 18 times, compared to the 15 times level prevailing at the start of the 20th century. As a result, speculative return is added just 0.1 percentage points to the annual investment return earned by our businesses over the long term. When we combine these two sources of stock returns, we get the total return produced by the stock market itself. Despite the huge impact of speculative return, up and down, during most of the individual decades, there is virtually no impact over the long term. The average annual total return on stocks of 9.6% then has been created almost entirely by enterprise, with only 0.1 percentage point created by speculation. The message is clear. In the long run, stock returns depend almost entirely on the reality of the investment returns earned by our corporations. The perception of investors, reflected by the speculative returns, counts for little. It is economics that controls long-term equity returns. Emotions, so dominant in the short term, dissolve. Even after almost 55 years in this business, however, I have absolutely no idea how to forecast these swings in investor emotions. I'm not alone. I don't know anyone else who has done so successfully, or even anyone who knows anyone who has done so. In fact, 70 years of financial research shows that no one has done so. But largely because the arithmetic of investing is so simple, I believe I can forecast the long-term economics of investing with remarkably high odds of success. Why? Simply because it is investment returns, the earnings and dividends generated by American business, that are almost entirely responsible for the returns delivered in our stock market. Put another way, while illusion, the momentary prices we pay for stocks, often loses touch with reality, the intrinsic values of our corporations, in the long run, it is reality that rules. To drive this point home, think of investing as consisting of two different games. Here's how Roger Martin, Dean of the Rotman School of Management of the University of Toronto, describes them. One is the real market, where giant publicly held companies compete, where real companies spend real money to make and sell real products and services, and, if they play with skill, earn real profits. This game also requires real strategy, determination, and expertise, real innovation, and real foresight. Loosely linked to this game is another game, the expectations market. Here, prices are not set by real things like sales margins or profits. In the short term, stock prices go up only when the expectations of investors rise, not necessarily when sales, margins, or profits rise. To this crucial distinction, I would only add that the expectations market is not only a product of the expectations of active investors, but the expectations of active speculators, trying to guess what these investors will expect and how they will act as each new bit of information finds its way into the marketplace. The expectations market is about speculation. The real market is about investing. The only logical conclusion: the stock market is itself a giant distraction that causes investors to focus on transitory and volatile investment expectations rather than what is really important, the gradual accumulation of the returns earned by corporate business. My advice to investors is to ignore the short-term noise of our emotions reflected in our financial markets and focus on the productive long-term economics of our corporate businesses. Shakespeare could have been describing the inexplainable hourly and daily, sometimes even yearly or longer, fluctuations in the stock market when he wrote, "Like a tale told by an idiot, full of sound and fury, signifying nothing." The way to investment success is to get out of the expectations market of stock prices and cast your lot with the real market of business. Don't take my word for it. Simply heed the timeless distinction made by Benjamin Graham, legendary investor, author of The Intelligent Investor, and mentor to Warren Buffett. He was right on the money when he put his finger on the essential reality of investing. In the short run, the stock market is a voting machine, but in the long run, it is a weighing machine. Ben Graham continues, using his wonderful metaphor of Mr. Market. The investor with a portfolio of sound stocks should expect their prices to fluctuate and should neither be concerned by sizable declines nor become excited by sizable advances. He should always remember that market quotations are there for his convenience, either to be taken advantage of or to be ignored. Imagine that in some private business you own a small share which cost you $1,000. One of your partners, named Mr. Market, is very obliging indeed. Every day he tells you what he thinks your interest is worth, and furthermore, offers either to buy you out or to sell you an additional interest on that basis. Sometimes his idea of value appears plausible and justified by business developments and prospects. Often, on the other hand, Mr. Market lets his enthusiasm or his fears run away with him, and the value he proposes seems little short of silly. If you are a prudent investor, will you let Mr. Market's daily communication determine your view as the value of your $1,000 interest in the enterprise? Only in case you agree with him, or in case you want to trade with him. Most of the time, you will be wiser to form your own ideas of the value of your holdings. The true investor will do better if he forgets about the stock market and pays attention to his dividend returns and to the operating results of his companies. Chapter 3. Casting Your Lot with Business. Occam's Razor Writ Large. So how do you cast your lot with business? Simply by buying a portfolio that owns the shares of every business in America and then holding it forever. It's a simple concept that guarantees that you will win the investment game played by most other investors who, as a group, are guaranteed to lose. Please don't equate simplicity with stupidity. Way back in 1320, William of Ockham expressed it well, essentially setting forth the precept that, when there are multiple solutions to a problem, choose the simplest one. William of Ockham actually expressed it more elegantly. Entities should not be multiplied unnecessarily. But the point is unmistakable. And so Occam's razor came to represent a major principle of scientific inquiry. And so, too, is owning all of U.S. business the essence of simplicity achieved by holding the stock market portfolio. For most of the past 80 years, The accepted stock market portfolio was represented by the Standard & Poor's 500 Stock Index, created in 1926 and now holding a list of 500 stocks, essentially composed of America's 500 largest corporations, weighted by the value of their market capitalizations. The index originally included just 90 companies, rising to 500 in 1957. In recent years, these 500 stocks have represented about 80% of the market value of all U.S. stocks. The beauty of a cap-weighted index is that it automatically adjusts to changing stock prices and never asks to buy and sell stocks for that reason. With the enormous growth of corporate pension funds during the 1950 to 1990 era, it was an ideal measurement standard, the benchmark or hurdle rate that would be the comparative standard for how their professional managers were performing. Today, the S&P 500 remains a valid standard against which to compare the returns earned by the professional managers of pension funds and mutual funds. In 1970, an even more comprehensive measure of the U.S. stock market was developed. Originally called the Wilshire 5000, it is now named the Dow Jones Wilshire Total Stock Market Index. It includes some 4,971 stocks, including the 500 stocks in the S&P index. However, because its component stocks too are weighted by their market capitalization, those remaining 4,471 stocks account for only about 20% of its value. Nonetheless, this broadest of all U.S. stock indexes is the best measure of the aggregate value of stocks, and therefore a superb measure of the returns earned in U.S. stocks by all investors as a group. Of course, the two indexes have very similar composition. Consider, for example, the 12 largest stocks in each and their weight in the construction of each index. It is hardly surprising that the two indexes have earned returns that are in lockstep with one another. The Center for Research in Security Prices at the University of Chicago has gone back to 1926 and calculated the returns earned by all U.S. stocks. Its data since 1970 have provided a virtually perfect match to the Dow Jones Wilshire Total Stock Market Index. In fact, returns of the two indexes parallel one another with near precision. From 1928 through 2006, you can hardly tell them apart. For the full period, the average annual return on the S&P 500 was 10.3%. The return on the total stock market was 10.1%. Of course, this represents what we call a period-dependent outcome. Everything depends on the starting date and the ending date. If we began the comparison at the beginning of 1930, instead of 1926, for example, the returns of the two were identical, 9.9% per year. Yes, there are variations over the interim periods. The S&P 500 was much the stronger, for example, in 1982 through 1990, when its annual return of 15.6% outpaced the total market index return of 14%. But in recent years, 1998 through 2006, small and mid-cap stocks did better, and the total market index return of 3.4% per year nicely exceeded the 2.4% return of the S&P 500. But with a long-term correlation of 0.98 between the returns of the indexes, 1.0 is perfect correlation, there is little to choose between them. Whichever measure we use, it should now be obvious that the returns earned by the publicly held corporations that compose the U.S. stock market must of necessity equal the aggregate gross returns earned by all investors in that market as a group. Equally obvious, as we'll learn in detail in the next chapter, the net returns earned by these investors must of necessity fall short of those aggregate gross returns by the amount of intermediation costs they incur. Thus, the reality of investing is that investors as a group must lose to the returns earned by business. This reality is obvious. While owning the stock market over the long term is a winner's game, beating the stock market is a loser's game. Such an all-market fund is guaranteed to outpace over time the returns earned by equity investors as a group. Once you recognize this fact, you can see that the index fund is guaranteed to win not only over time, but every year and every month and week, even every minute of the day. Because no matter how long or short the time frame, Yes, the gross return in the stock market minus intermediation costs equals the net return earned by investors as a group. If the data do not prove that indexing wins, well, the data are wrong. Over the short term, however, it doesn't always look as if the S&P 500 index, still the most common basis of comparison for mutual funds and pension plans, or the Dow Jones Wilshire 5000 index is winning. That's because there is no possible way to calculate the returns earned by the millions of diverse participants, amateur and professional alike, Americans and investors in foreign countries, in the U.S. stock market. So what we do in the mutual fund field is calculate the returns of the various funds, counting each fund rather than each fund's assets as one entry. Since there are lots of small cap and mid cap funds, usually with relatively modest asset basis, they make a disproportionate impact on the data. When small and mid cap funds are leading the total market, the all-market index fund seems to lag. When small and mid cap stocks are lagging the market, the index fund looks formidable indeed. Nonetheless, the exercise of calculating how the returns earned by the stock market itself compares with returns earned by the average equity fund is both illuminating and persuasive. If we compare the results of what are described as large-cap core funds with the returns of the S&P 500, because of its market capitalization weightings, a large-cap core index, the advantage of the index itself is impressive. During the 37-year period, 1969 to 2006, the S&P 500 index fell into the bottom quartile in only 2 years and has not done so since 1979. The index has outpaced the average fund in 26 of the remaining 35 years, including 11 of the past 15 years. Its average ranking was in the 58th percentile, that is, outperforming 58% of the comparable actively managed funds, leading, as we shall see in the next chapter, to enormous superiority over time. It is hard to imagine that even a single one of the large-cap core equity funds has a similar record of consistency. Consistency matters. A fund that is good or very good in the vast majority of years produces a far larger long-term return than a fund that is superb in half of the years and a disaster in the remaining half. Single-year rankings, then, ignore the sheer arithmetic advantage of that consistency. In the coming chapters, the impact of that long-term consistency is cataloged over the past 25 years. I should add that these annual data are what we call survivor biased. That is, that they exclude the records of the inevitably poorer performing funds that regularly go out of business. As a result, this further understates the success of the market-owning index strategy. Investing in the first index mutual fund, $15,000 invested in 1976, value in 2006, $461,771. Much criticism has been heaped on the S&P 500 for its choice of stocks, often picking new economy stocks such as JDS Uniphase and Yahoo near their inflated peak prices during the bubble just before they crashed, taking on a growth bias at exactly the wrong time. While the criticism is valid, the excellent long-term record of the flawed index belies the existence of a significant problem. In fact, since the market peaked early in 2000, the S&P 500 has had only a single significantly subpar year, 2000, 3 years at about par, and 3 years, 2003, 2004, and 2006, in the top quartile of its peers. I can't imagine that the vast majority of money managers wouldn't have been ecstatic with such an outcome. Thus, the recent era has not only failed to erode, but nicely enhanced the lifetime record of the world's first index fund, now known as Vanguard 500 Index Fund. Let me be specific. At a dinner on September 20th, 2006, celebrating the 30th anniversary of the fund's initial public offering, the counsel for the fund's underwriters reported that he had purchased 1,000 shares at the original offering price of $15 per share, a $15,000 investment. The value of his holding that evening including shares acquired through reinvesting the fund's dividends and distributions over the years, he proudly announced, was $461,771. Now there's a number that requires no comment. Well, maybe one comment. Of the 360 equity mutual funds then in existence, only 211 remain. This cumulative long-term winning record confirms that owning American business through a broadly diversified index fund is not only logical, but to say the least, incredibly productive. Equally important, it is consistent with the age-old principle expressed by Sir William of Ockham. Instead of joining the crowd of investors who try to gain an edge by dabbling in complex machinations involved in picking stocks and trying to outguess the stock market, two tasks that are inevitably fruitless for investors in the aggregate, choose the simplest of all solutions: buy and hold the market portfolio. Don't take my word for it. Before you write off the value of the simple index fund solution, recognize that it has been adopted as a cornerstone of investment strategy for many of the nation's pension plans operated by our giant corporations and state and local governments. Indexing is also the predominant strategy for the largest of them all, the retirement plan for federal government employees, the Federal Thrift Savings Plan. The plan has been a remarkable success and now holds some $173 billion of assets for the benefit of our public servants and members of uniformed services. Under the plan, the various government departments automatically make a contribution equal to 1% of annual pay and matching contributions of up to 5% of pay, meaning that a federal employee who contributes 5% of their salary to the plan receives a total matching contribution of 6%. All contributions and earnings are tax-deferred until withdrawal, much like the corporate 401k thrift plans. Overcoming what must have been some serious reservations, even the Bush administration determined to follow the Federal Thrift Savings Plan model in its plan for personal savings accounts as an optional alternative to our Social Security program. Indexing is also praised across the Atlantic pond. Listen to these words from Jonathan Davis, columnist for the London Spectator. Nothing highlights better the continuing gap between rhetoric and substance in British financial services than the failure of providers here to emulate Jack Bogle's index fund success in the United States. Every professional in the city knows that index funds should be core building blocks in any long-term investor's portfolio. Since 1976, the Vanguard Index Fund has produced a compound annual return of 12%, better than 3/4 of its peer group. Yet even 30 years on, ignorance and professional omerta still stand in the way of more investors enjoying the fruits of this unsung hero of the investment world. Chapter 4. Why Most Investors Lose to the Market. The Relentless Rules of Humble Arithmetic. Before we turn to the success of indexing as an investment strategy, let's explore in a bit more depth just why it is that investors as a group fail to earn the returns our corporations generate through their dividends and earnings growth, ultimately reflected in the long run in the prices of their stocks. To understand why they do not, we need only to recognize the simple mathematics of investing. All investors as a group must necessarily earn precisely the market return, but only before the costs of investing are deducted. After subtracting the costs of financial intermediation, all of those management fees, all of those brokerage commissions, all of those sales loads, all of those advertising costs, all of those operating costs, the returns of investors as a group must and will and do fall short of the market return by an amount precisely equal to the aggregate amount of those costs. In a market that returns 10%, we investors together earn a gross return of 10%. Duh. But after we pay our financial intermediaries, we pocket only what remains. And we pay them whether our returns are positive or negative. In investing, as a group, we get precisely what we don't pay for. So if we pay nothing, we get everything. There are, then, these two certainties. 1. Beating the market before costs is a zero-sum game. 2. Beating the market after costs is a loser's game. The returns earned by investors in the aggregate inevitably fall well short of the returns that are realized in our financial markets. How much do these costs come to? For individual investors holding stocks directly, trading costs average about 1.5% per year. That cost is lower, about 1%, for those who trade infrequently, and much higher for investors who trade frequently. For example, 3% for investors who turn their portfolios over at a rate above 200% per year. In equity mutual funds, management fees and operating expenses, combined, the expense ratio, average about 1.5% per year of fund assets. Then add, say, another 0.5% in sales charges, assuming that a 5% initial sales charge is spread over a 10-year holding period. If the shares are held for 5 years, the cost would be twice that figure, 1% per year. But then add a giant additional cost, all the more pernicious by being invisible. I'm referring to the hidden cost of portfolio turnover, estimated at a full 1% per year. The average fund turns its portfolio over at a rate of about 100% per year, meaning that a $5 billion fund buys $5 billion of stocks each year and sells another $5 billion. At that rate, brokerage commissions, bid-ask spreads, and market impact costs add a major layer of additional costs. Result? The all-in cost of equity fund ownership can come to as much as 3% to 3.5% per year. I've ignored the hidden opportunity cost that fund investors pay. Most equity funds hold about 5% in cash reserves. If stocks earn a 10% return and these reserves earn 4%, that cost would add another 0.3% to the annual cost, 5% times the 6% differential in earnings. So yes, costs matter. The grim irony of investing, then, is that we investors as a group not only don't get what we pay for, we get precisely what we don't pay for. So if we pay nothing, we get everything. Let me illustrate this simple lesson with a wonderful quotation I came across a few years ago when I was rereading Other People's Money by Louis D. Brandeis, first published in 1914. Brandeis, later to become one of the most influential jurists in the history of the U.S. Supreme Court, railed against the oligarchs who a century ago controlled investment America and corporate America alike. Brandeis described their self-serving financial management and their interlocking interests as trampling with impunity on laws human and divine, obsessed with the delusion that 2 + 2 make 5. He predicted, accurately as it turned out, that the widespread speculation of that era would collapse, a victim of the relentless rules of humble arithmetic. He then added this unattributed warning. I'm guessing it's from Sophocles. Remember, O stranger, arithmetic is the first of the sciences and the mother of safety. Brandeis's words hit me like the proverbial ton of bricks. Why? Because the relentless rules of the arithmetic of investing are themselves so obvious. It's been said, by my detractors, that all I have going for me is the uncanny ability to recognize the obvious. The curious fact is that most investors either seem to have difficulty recognizing what lies in plain sight, right before their eyes, or, perhaps even more pervasively, refuse to recognize the reality because it flies in the face of their deep-seated beliefs and their biases, their overconfidence, and their uncritical acceptance of the way that financial markets have worked, seemingly forever. What is more, it is hardly in the interest of our financial intermediaries to encourage their investor clients to recognize the obvious reality. Indeed, the self-interest of the leaders of our financial system almost compels them to ignore these relentless rules. Paraphrasing Upton Sinclair, it's amazing how difficult it is for a man to understand something if he's paid a small fortune not to understand it. Our system of financial intermediation has created enormous fortunes for those in the field of managing other people's money. Their self-interest will not soon change. But as an investor, you must look after your own self-interest, for only by facing the obvious realities of investing can the intelligent investor succeed. How much do the costs of financial intermediation matter? A ton. Indeed, the higher costs of equity funds have played the determinative role in explaining why fund managers have lagged the returns of the stock market itself so consistently for so long. When you think about it, how could it be otherwise? By and large, these managers are smart, well-educated, experienced, knowledgeable, and honest. But they are competing with each other. When one buys a stock, another sells it. There is no net gain to fund shareholders as a group. In fact, they incur a loss equal to the transaction costs they pay to those helpers that Mr. Buffett warned us about in Chapter 1. Investors pay far too little attention to the costs of investing. It's especially easy to underrate their importance under today's conditions. 1. When many costs are hidden from view, portfolio transaction costs, the unrecognized impact of front-end sales changes, taxes incurred on realized gains. 2. When stock market returns have been high. During the 1980s and 1990s, stock returns averaged 17.5% per year, and the average fund provided a non-trivial but clearly inadequate return of 15%. And especially 3. When investors focus on short-term returns, ignoring the truly confiscatory impact of cost over an investment lifetime. Perhaps an example will help. Let's assume the stock market generates a total return averaging 8% per year over a half-century. Yes, that's a long time, but an investment lifetime is now actually even longer. 65 or 70 years for an investor who goes to work at age 22 and begins to invest immediately and works until, say, age 65, and then continues to invest for an actuarial expectancy of 20 or more years thereafter. Now let's assume that the costs of the average mutual fund continue at their present rate of at least 2.5% per year. Result? A net annual return of just 5.5% for the average fund. $10,000 grows to $469,000, or $145,400. Where did that $323,600 go? Based on these assumptions, let's look at the returns earned on $10,000 over 50 years. The simple investment in the stock market grows to $469,000, a remarkable illustration of the magic of compounding returns over an investment lifetime. In the early years, growth at a 5.5% annual rate doesn't look all that different from the growth in the stock market itself. But ever so slowly, the rates begin to diverge, finally, truly dramatically. By the end of the long period, the value accumulated in the fund totals just $145,400, an astonishing shortfall of $323,600 to the cumulative return earned in the market itself. In the investment field, time doesn't heal all wounds. It makes them worse. Where returns are concerned, time is your friend. But where costs are concerned, time is your enemy. This point is powerfully illustrated when we consider how much of the value of the $10,000 investment is eroded with each passing year. By the end of the first year, only about 2% of the value of your capital has vanished, $10,800 versus $10,550. By the 10th year, 21% has vanished, $21,600 versus $17,100. By the 30th year, 50% has vanished, $100,600 versus $49,800. And by the end of the period, costs have consumed nearly 70% of the potential accumulation available simply by holding the market portfolio. The investor, who put up 100% of the capital and assumed 100% of the risk, earned but 31% of the market return. The system of financial intermediation, which put up 0% of the capital and assumed 0% of the risk, essentially confiscated 70% of that return, surely the lion's share. What we see here, and please don't ever forget it, is that over the long term, the miracle of compounding returns is overwhelmed by the tyranny of compounding costs. Add that mathematical certainty to the relentless rules of humble arithmetic described earlier. But enough of theory and hypothetical examples. Let's see how this principle works in the real world. During the quarter century from 1980 to 2005, the return on the stock market itself, measured by the Standard & Poor's 500 index, averaged 12.5% per year. The return on the average mutual fund averaged just 10%. That 2.5% differential is about what one might have expected, given our earlier 3% rough estimate of fund costs. Never forget, market return minus cost equals investor return. Simply put, our fund managers, sitting at the top of the investment food chain, have confiscated an excessive share of the financial market's returns. Fund investors, inevitably at the bottom of the food chain, have been left with too small a share. Investors need not have incurred that loss, for they could have easily invested in a simple index fund tracking the S&P 500 index. Such a fund actually returned 12.3% per year during that period, the market return of 12.5% less costs of just 0.2%. That's an annual margin of superiority of 2.3% over the average fund. On first impression, that annual gap may not look large, but when compounded over 25 years, it reaches staggering proportions. A $10,000 initial investment in the index fund grew by a remarkable $170,800 compared to growth of just $98,200 in the average equity mutual fund, only 57% of the total accumulation in the index fund. But let's face the facts. Both of these accumulations are overstated, for they are based on current 2005 dollars, which have less than half the spending power they enjoyed in 1980. During this period, inflation eroded the real buying power of these returns at an average rate of 3.3% per year. When we turn those nominal dollars, the dollars that we earn and spend and invest every day, into real dollars, dollars that are adjusted to take inflation into account, the results for that original $10,000 investment tumble sharply. The cumulative real profit after compounding came to just $40,600 for the average actively managed equity fund, compared to $76,200 for the passively managed index fund. Now, the average fund produced barely one-half, actually 53%, of the profit earned by the stock market itself through the simple index fund, a return that was there for the taking. It's in the nature of arithmetic that deducting the same inflation rate from both figures further increases the comparative advantage of the investment with the higher return, in this case, the index fund. Yes, costs matter. Indeed, costs make the difference between investment success and investment failure. In short, the humble arithmetic of investing, the logical, inevitable, and unyielding penalty assessed by investment costs and rising living costs, has devastated the returns earned by mutual fund investors. Using Justice Brandeis's formulation, our mutual fund managers seem obsessed with the delusion and are foisting that delusion on investors that a nominal gross return of 12.5% per year in the stock market, minus fund expenses of 2.5%, minus inflation of 3.3%, still equals a real net return of 12.5%. Well, to state the obvious, it doesn't. You can add and subtract for yourself. It equals, you guessed it, only 6.7%. Unless the fund industry changes and improves the net return it delivers to fund shareholders, it will falter and finally fail, a victim, yes, of the relentless rules of humble arithmetic. Were he looking over your shoulder as you read this book, Justice Brandeis surely would be warning you, remember, O reader, that arithmetic is the first of the sciences and the mother of safety. So sharpen your pencils. Do your own arithmetic. Realize that you are not consigned to playing the hyperactive management game that is played by the overwhelming majority of individual investors and mutual fund owners alike. The index fund is there to guarantee that you will earn your fair share of whatever returns our businesses earn and our stock market delivers. Don't take my word for it. The innate superiority of the index fund has, perhaps grudgingly, been endorsed by at least a few mutual fund industry insiders. When he retired, here's Peter Lynch, the legendary manager who steered Fidelity Magellan Fund to such great success during his 1977 to 1990 tenure. The S&P
Stories of Futures Past presents 5 stories featuring parallel worlds. Placebo by David Mason. The Doorway by Evelyn E. Smith. Back to Julie by Richard Wilson. A Hitch in Time by Frederick Pohl. Never Meet Again by Algis Budrys. Placebo by David Mason, originally published in Infinity Science Fiction, November 1955. Narrated by Tom Trisser. Each 1955 was worse than the last. The object appeared in the middle of Main Way, about 50 feet from the statue of Vachel Lindsay, at least 100 from anything else. It was much too big and complicated to have been hidden anywhere, and it hadn't any wheels, tracks, wings, or other visible means of movement. Corrigan, looking the object over, decided that it could not have come from any logical place in the world. Not being prejudiced, he then thought a little about the illogical places, and the places that weren't in the world. Corrigan decided that it must have been another attempt at time travel, and he clucked his tongue sympathetically. Well, someone had to break the news. Corrigan arose from the grass and walked toward the object. There was a young man sitting in the object, on a sort of high saddle. He looked a little wild-eyed, and he seemed to be talking to himself as he pulled and twisted at the rows of controls in front of him. Corrigan, looking up at him, decided that he couldn't be very healthy, and that the stiff grey garments he wore must be extremely uncomfortable. "Greetings, traveller," Corrigan called. "You're speaking English!" the young man exclaimed. "Good! Maybe I can get some help here. What year is this?" 1955 by most systems." The young man turned a little paler. "I just left 1955, he said unhappily. 4 times, in fact. 4 different 1955s, and each one's a bit worse. Now the machine won't work." "Your theory's wrong," Corrigan said calmly. "Hasn't it occurred to you yet that time travel might be impossible?" The young man made a choked sound. He began to climb down from his perch, keeping his eyes fixed suspiciously on Corrigan as he did so. He saw Corrigan as a small brown man, dressed in loose blue trousers, barefooted, and with a puff of white hair that seemed never to have been properly cut. The lawns and grassy roads, the bright and impermanent-looking buildings, and Corrigan himself, all added up to one thing in the young man's mind. "You're wrong," Corrigan said. "I'm not a lunatic, and this isn't an asylum. We don't have them." The young man on the ground now stared at Corrigan in evident horror. "Mind-reading?" "More or less," Corrigan said. "It saves time. For instance, you're Darwin Lenner, and you'd like very much to get back to wherever you started from. In fact, you have to, or something unpleasant might happen to you, by your standards." "I'll be absent without permission," Lenner admitted. I wish you wouldn't do that." "Only when absolutely necessary," Corrigan smiled. "I'm a philosopher by trade myself, not a mind-reader. My name's Philip Corrigan, and I'll be very glad to help you on your way. But I think it might be a little difficult. We aren't really a very mechanically minded people here." Lenner ran his hands through his hair. "I've got to get back. Isn't there anybody who knows something about time machines?" Corrigan had been thinking swiftly. He had also been carrying on a conversation which Lenner could not possibly hear with a man who was several miles away. "Burwell, he wants to go home." "Fine, he ought to. Why doesn't he?" "He lost his confidence. He thinks his machine's broken down." "That kind, eh? I suppose the thing never really did work very well." Most of them don't. They go travelling around hit or miss through probability under the operator's own mental stream. But this fellow probably comes from a world where an idea like that's illegal. Sounds like it. Corrigan, take him on a guided tour or something, and keep him busy. I'll be over as soon as I can. I'm going to do something for his self-confidence. Here's the story to give him. Corrigan had always enjoyed conducting guided tours, and he was enjoying this one especially well. He had a slightly wicked taste for complicated teasing, and Lena was a perfect object. He had evidently come from one of the more unpleasant probabilities, a world full of complex rules and harshly restrictive. Anything that he saw bothered him. The handsome girls, wearing unstrategically placed flowers and very little else, the flocks of children, as plentiful as pigeons and apparently as free of supervision, the almost total absence of anybody actually performing useful work, all of it contributed to Lena's increasing nervousness. The guided tour went in a wide circle, and Lena and Corrigan wound up sitting in a tavern facing on Mainway. Lena ignored the green drink before him and peered unhappily out the big window toward his machine. "Where is that friend of yours?" he asked for the 5th time. "He'll be here," Corrigan assured him. "Why hurry? Don't you like it here?" Lena's mouth hardened. He looked around him and shook his head. "No." He spoke almost apologetically. "I'm sorry. Well, look, old fellow, no hard feelings, I hope, but this world of yours is primitive. Degenerate, I'd say." "Primitive?" "No laws, not even morals. Those girls. And, of course, you don't have any civilized advantages, not even ground transportation. That man you spoke of has to walk here, and that's something else I don't understand. You say he's another time traveller." "Probability traveller, actually," Corrigan corrected. "All right, probability. Why does he stay here? Why would a really intelligent man give up civilization?" "Well, you know how it is. He's gone native, you might say. Life among the lotus eaters and all that. Might happen to anybody, even yourself." Lena shuddered. "It's all right, though," Corrigan continued. "He'll be here any minute, and I'm sure he'll be able to help. Knows all there is to know about these machines. In fact, here he comes now." Burwell entered, and Corrigan could hardly suppress a small chuckle. Burwell had picked up Lena's ideas about what a man of intelligence and authority ought to look like, and had gone to some trouble to look the part. He was wearing a uniform of some sort, spectacles, and an expression of extreme wisdom. "I'm sure I can repair what's wrong," Burwell told Lena. "Let's go and look at your machine." Arriving, Burwell climbed over the mechanism with an air of bored ability, occasionally thumping at something, adjusting something else, or hitting a part with the tool until it rang. He muttered to himself as he worked, allowing the sound of his musings to drift in Lena's directions. Badly twisted impeller. The varish is more or less waffled. Let's see if... there we are." He climbed down and solemnly shook hands with Lena. "Fine machine you've got there, my boy. It'll take you back to your own place quite easily now. There wasn't a thing wrong except the drift crotch. However, I wouldn't use it again if I were you. There's no real control on these things. A man could end up anywhere. And, of course, you'd never find your way back here without control." "Well, thanks," Lena said doubtfully. He glanced around. "It's a shame there's no way we could regularly communicate between our worlds. There's a lot we could do for this one." "I'm sure of that," Burwell said, hastily looking away. "But it isn't worth the danger and difficulty of reaching us. For myself, it doesn't matter any more." He assumed a nobly tragic expression. "But you are young. You've got your life ahead of you. Your state and your society need you. I'm glad to help you on your way." Lena mounted the machine, and Burwell beamed a thought at Corrigan. "I've convinced him that the thing works, and that it would not be easy to come back. Actually, that machine of his is a real work of art. It doesn't do a damn thing. This boy comes from a place where they have to have a mechanical crutch for everything. His gadgets are pink pill stuff. Something to convince him he can do things he could do anyway. All we have to do now is give him a small mental shove to help him along, and he'll be home in no time. All right now, shove." Corrigan and Burwell shoved. Lena and his machine faded and were gone, leaving only a flattened place on the grass. "Brrr," Burwell said. "Am I glad that worked. If he'd stayed another week or so, we would have to have our first lunatic of the century." Or worse, Corrigan said, stirring the grass with his toes. Did you get what he was thinking about when he talked about his world and ours getting into touch and civilizing us? I got it all right, Burwell said. The fellow's mind was a swamp, a real primitive, and just like any other primitive, all he needed was a placebo from a witch doctor. Me in my savage regalia. Just let me get this thing with the glass in it off my nose, and these button things opened up a bit, and we can get on with that chess game. I hope the next traveller picks somewhere else to land, though. I've never felt so silly in my life.
The end. Subscribe for your daily stories of futures past. And now, for the next story.
The Doorway by Evelyn E. Smith. Originally published in Fantastic Universe, September 1955. Narrated by Tom Trissel. It is my theory, Professor Falabella said, helping himself to a cookie, that no one ever really makes a decision. What really happens is that whenever alternative courses of action are called for, the individuality splits up and continues on two or more divergent planes, very much like the parthenogenesis of an unicellular animal. Delicious cookies, these, Mrs. Hughes.
Thank you, Professor, Gloria simpered. I made them myself. You must give us the recipe, said one of the ladies, and the others murmured agreement, glad to get their individualities on a plane they could understand.
Since most decisions are hardly as momentous as the individual imagines, Professor Falabella continued, and since the imagination of the average individual is very limited, many of these different planes, or as they are colloquially known, space-time continuums, may exist in close, even tangential relationship. Gloria rose unobtrusively and took the teapot to the kitchen for a refill. Her husband stood by the sink, moodily drinking whiskey out of the bottle, so as to avoid having to wash a glass afterward.
Bill, you're not being polite to our guests. Why don't you go out and listen to Professor Falabella?
I can hear him perfectly well from here, Bill muttered, and indeed the Professor's mellifluous tones pervaded every nook and cranny of the thin-walled house. Long-winded cultist. What is he a professor of, I'd like to know?
Professor Falabella is not a cultist, affirmed Gloria angrily. He's a great philosopher.
Bill Hughes said something unprintable. If I'd married Lucy Allison, he continued unkindly, she'd never have filled the house with long-haired cultists on my so-called day of rest. Gloria's soft chin trembled, and her blue eyes filled with tears. She was beginning to put on weight, he noticed.
I've been hearing nothing but Lucy Allison, Lucy Allison, Lucy Allison for the past year. You said yourself she looked like a horse.
Horses, he observed, have sense. He was being brutal, but he couldn't help it and didn't want to. Professor Falabella was only the most long-winded of a long series of mystics Gloria was forever dragging into the house. The trouble with the half-educated, he thought bitterly, is that they seek culture in the most peculiar places. I'll bet she would have let me have peace on Sunday, he said. It just goes to show what happens when you marry a woman solely for her looks. He drained the bottle, then hurled it into the garbage pail with a resounding crash. Gloria's shoulders shook as she filled the kettle.
I wish I decided to be an old maid, she sobbed.
A very unlikely possibility, he thought. Even now, shop-worn as she was, Gloria could have fairly wide range of suitors should something happen to him. She looked sexy, but how deceiving appearances could be. Professor Falabella was still talking as Bill and Gloria emerged from the kitchen. I believe that it is possible for an individual who exists on a limited plane of imagination to transpose from one plane to an adjacent one without difficulty. Great heavens, what was that? Something had whisked past the archway leading to the foyer.
Don't pay any attention, Gloria smiled nervously. The house is haunted. My dear, one of the ladies offered, I know the most marvellous exterminator.
The house,
Gloria assured her coldly, really is haunted. We've been seeing things ever since we moved in. And she really believed it, Bill thought. Believed that the house was haunted, that is. Of course he had seen things too, but he was enlightened enough to know that ghosts don't exist, even if you do see them. Professor Falabella cleared his throat. As I was saying, it is possible to send the individual through another, dimension, as some popular writers would have it, to one of his other spatial existences on the same temporal plane. It is merely necessary for him to find the door. Nonsense, Bill interrupted. Wholly unmitigated nonsense. Every head swiveled to look at him. Gloria restrained tears with an effort. Brute, someone muttered. But ridicule apparently only stimulated the professor. He beamed. You don't believe me. Your imagination cannot extend to the comprehension of the multifariousness of space. Nonsense, Bill said again, but less confidently. I believe that I have discovered the doorway, Professor Falabella continued, and the way is open. However, most people fear to penetrate the unknown, even though it is to enter another phase of their own existence. I do admit that the shock of spatial transference, no matter how slight, combined with the concrete awareness of a previous spatial relationship, would be perhaps too much for the keenly sensitive individualism. Bill opened his mouth. I know what you're about to say, young man. You don't have to be a mind reader to know that, Bill assured him. His consonants were already a little slurred, and he knew Gloria was ashamed of him. It served her right. He'd been ashamed of her for years. Professor Falabella smiled. His teeth were very sharp and white. Very well, Mr. Hughes. Since you are a skeptic, perhaps you will not object to being the subject of our experiment yourself. What kind of an experiment? Bill asked suspiciously. Merely to go through the door. Any door can become the doorway if it is transposed into the proper spatial dimension. That door, for instance. Professor Falabella waved his hand toward the doorway of what Gloria liked to call Bill's study. You mean you just want me to open the door and go into that room? Bill asked incredulously. That's all? That is all. Of course, you go with the awareness that it is the threshold of another plane, and that you will step voluntarily from this existence to an adjacent one. Sure, Bill said. He had just remembered there was a nearly full bottle of Calvert in the bottom drawer of the desk. Sure, anything to oblige. Very well, go to the door, and keep remembering that your own free will you are passing from this plane to the next. Look out, everybody, Bill called raucously as he pulled open the door. I'm coming in on the next plane. No one laughed. He stepped over the threshold, shutting the door firmly behind him. A wonderful excuse to get away from those blasted women. He'd climb out of the window as soon as he'd collected the whiskey, and give them a nervous moment thinking he'd really passed into another existence. It would serve Gloria right. For a moment, as he crossed, he had a queer sensation. Maybe there was something in what Professor Falabella said. But no, there he was in the study. All that mumbo-jumbo was getting him down, that was all. He was a nervous man, only nobody appreciated the fact. Taking a cigarette out of the pack in his pocket, he reached for the lighter on his desk. It wasn't there. Time and time again he'd told Gloria not to touch his things, and always she'd disobeyed him. Company was coming, and she must tidy up. Cooking and cleaning, that was all she was good for. But this was carrying tidiness too far. She'd even removed the ashtrays. And where did that glass block paperweight come from? He'd had a penguin in a snowstorm, and he'd been happy with it. This was too much. He'd tell Gloria off, stealing a man's penguin. He opened the door into the living room and bumped into Lucy Allison. "Don't you think you've been in there long enough, Bill?" she asked acridly. "I'm sure your guests would appreciate catching a glimpse of you. Why, hello, Lucy, he said, surprised. I didn't know Gloria had invited you. Gloria, 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 Lucy cut across his sentence. You've been talking about nothing but that dumb little blonde for months. Because of the people in the room beyond, her voice was pitched low, but her pale eyes glittered unpleasantly behind her spectacles. I wish you had married her. You'd have made a fine pair. Gently, caressingly, the short hairs on the back of Bill's neck rose. Come back in here, Lucy said, hauling him back into the living room where a number of people who had been enjoying the domestic fracas suddenly broke into loud and animated chatter. Dr. Hildebrand was telling us all about nuclear fission. Can't find an ashtray, Bill muttered, seizing on something tangible. Can't find an ashtray in the whole darn place. We've been over this millions of times, Bill. You know, she smiled at the guests, a smile that carefully excluded Bill. I'm allergic to smoke, but I never can get my husband to remember he isn't to smoke inside the house. Now take the neutron, for example, Dr. Hildebrand said through a mouthful of pâté. What is the neutron? It is only... What was that? The wraith of Gloria crossed the foyer and disappeared. Bill took a step forward, then stood still. Lucy smiled self-consciously. That's nothing at all. The house is merely haunted. Everyone laughed. Forgot something, Bill muttered, and dashed back into the study. He yanked open the bottom drawer of the desk. Sure enough, there was a bottle of Chenelet, nearly a third full. There are some advantages, he thought as he tilted it to his lips, in having a limited imagination.
The end. Subscribe for your daily stories of futures past. And now, for the next story.
Back to Julie by Richard Wilson, originally published in Galaxy Science Fiction, May 1954. Narrated by Tom Trisser. You can't go shooting off to that dimension for peanuts. I don't want to give you the impression that peanuts are in short supply here, or that our economy is in the fix of having to import them sidewise. What I'm trying to convey is that if you're one of the rare ones functionally equipped to do the side shuffle, you ought to be well paid for it, in any coin. That's what I told Krasnow, and he wasn't after peanuts. I'll do it, I said, if you'll make it worth my while. I'd hardly expect you to do it for nothing, he replied reproachfully. How much do you want? I told him. The amount shook him up, but only briefly. Okay, he said grudgingly. I suppose I'll have to give it to you, but the stuff had better be good. Oh, it is, I assured him, and you don't have to be afraid, because I couldn't possibly skip with the loot. I'll have to travel naked. I can't get there with so much as a sandal on one foot or a filling in a single tooth. Fortunately, my teeth are perfect. Sweat poured off Krasnow's florid face as he worked the combination of his office safe. His fat jowls quivered unhappily around his cigar while he counted out the bills. 10% was cash in advance, and the rest went into a bank account in my name. I paid off a batch of bills, then stripped and did my off to Buffalo. Honest John Krasnow was a crooked district attorney who wanted to be governor and then president. He had the machine, but he didn't have the people. And because he needed the people, he needed me. I had been to this other dimension, the one on the farthest branch of the time tree, and I could give him what he wanted. Krasnow found out about it after I was hauled up in front of him on a check-kiting charge. I'd had something of a reputation before I got into difficulties, and, in trying to live up to the reputation, I had done some plain and fancy financing. Nothing that 15 to 20 grand wouldn't have fixed, but while I scrounged around, trying to get cash, I kited a few checks. They pyramided me right into the DA's office, where Krasnow was probably sympathetic. How, he asked, could a man of your standing in the scientific world stoop so low? It developed into quite a lecture, and even coming from Krasnow, it made me feel pretty low. So I began explaining. I told him where I was born, and where I went to school, and where I had taken my sabbaticals, including this other dimension. And Krasnow believed me. I can't account for it, except possibly because he knew he was a crook, and I knew I wasn't one. Exactly. Anyway, he believed me, and we made the deal, and I did the side shuffle, as agreed. The journey to that other dimension is not a pleasant one. It does disturbing things to the stomach, and you see everything thin and elongated, as if you're sitting too far to the side in a movie theatre. I got there, however, and waited for the hiccups to subside. Hiccupi laterali, I had called them when I considered writing an article for the medical journal after my first trip. With the hiccupi gone, I stole some clothing, which was one of the riskiest parts of the program, and waited for morning. I didn't have any money, of course, so I had to hitchhike into town. I could have stolen myself a better fit, but people aren't clothes conscious in that dimension. They're more interested in what you are and what you can do. The driver of the car that gave me a lift asked, "And what is your field of endeavour?" I told him, "I am able to eliminate the long wait in ivory production by accelerating the growth cycle of elephants." He was deeply impressed and tipped me handsomely. I was less impressed with his talent for growing cobbler's corn, and therefore had to return only a small part of the sum he gave me. The world of this dimension had developed some remarkable parallels to Earth. I mean our Earth, which falls into what I have called designated Timeline 1.1, since it's the Earth with which I am most familiar. Every other world that has a language calls itself Earth 2. I had to visit briefly hundreds of the lateral worlds, hovering over primordial swamps, limitless oceans, insect kingdoms, and radioactive planetoids, before I found the one that was truly parallel. It existed in Timeline 17.08, and it had refrigerators, platinum blondes, automobiles, airplanes, apple pie, tabloids, television, scotch and soda. Just about everything we think makes life worthwhile. But it had its little differences, which was only to be expected in a timeline where the bionomics would create a new world each time someone changed his mind. Thus, the cobbler's corn man was driving what looked to me like a Chevrolet, but which was a Morton in his world. He let me off near a downtown restaurant where, thanks to a little exchange of talent talk, I had enough money for breakfast. It was considered unethical to swap talent talk outside the limits of certain rigidly defined groups, so I didn't try to out-impress the waitress. Fed, and feeling my stolen clothes a bit better, I walked to the recorder's office and spent the rest of the morning looking up old documents. There was nothing there for Krasnow, as I had expected. But for me there was a very pretty file clerk. Talking to her, I verified my impression that human instincts and relationships were much the same in this dimension as in my own, except in the one basic respect that interested Krasnow, of course. The file clerk and I lunched together, and then I spent the afternoon in the library. But I didn't find anything there either, and then I had dinner with her. She said her name was Julie. I told her mine was Heck, for Hector, which it is. She thought this was awfully cute, and we got along fine. Julie had a delightful apartment and a matching sense of hospitality. The following day, when she went to work, I stayed home and washed the dishes and made the bed and used the telephone. I ran up quite a bill with my long-distance calls, but I found out what I needed to know. I impressed a lot of people with my elephant story, and pretended to be impressed hardly at all with what they told me they did, although often I was, very much. The trouble with these people is that they no longer know how to lie, if that can be listed as trouble. I don't think it can. Neither did Krasnow, obviously. He'd never have sent me off on my expensive side trip if he had. Of course, Krasnow looked at it objectively. What he wanted from Timeline 17.08 was not for himself. It was for everybody else. He wanted the formula for the truth gas these people had developed long ago and loosed upon their world to put a stop to wars. They had been in a bad way, although no worse than the sort of problem we were up against. Their trans-ocean squabbles and power politics seemed to have settled into a pattern of a war or two per generation, just like us. Hence, the man who invented the truth gas became a global hero after a certain amount of cynicism and skepticism. All the doubts vanished naturally once the gas got to working, and so did war. You can't do much plotting and scheming if, every time you open your mouth to tell a lie, you stammer, sweat, turn red, and gasp for breath. It's a dead giveaway. Nobody tries it more than once. 1 or 2 men had tried to nullify the gas or work out a local antidote, either as a pure research project or through power madness. But because they had to state their purposes as soon as they thought of them, they were put away. Neat. Very neat. What I wanted was a formula for the truth gas. Its location wasn't exactly a secret in this land of complete candor, but it wasn't writ large on any wall for all to see either. They kept it in the capital, located about where our Omaha is, on file among the vital statistics. I took a superjet out there. I had no trouble posing as a historian entitled to the facts. The gas didn't work on me, you see, because it was adjusted to the physiology of that timeline. There was just enough difference between us for it not to make me stick to the truth. "We'll write out the formula for you," I was told obligingly, "but you'll have to sign the usual statement." "Of course," I said. "Which one is that?" "The one that says you won't publish it and will destroy your copy when it has served your research purpose without letting anyone else see it." "Oh, that statement," I said. I signed freely, told my elephant story, and departed in an aura of goodwill. The jet got me back that same evening. Julie fixed me up a snack, and we discussed how pretty she was and how nice I was. I had everything Krasnow wanted now. I felt pretty good about it, because there was nobody else who could have done the job for him, and because it wasn't spying, really. Earth 1.1 on the timeline is world enough for Krasnow, I'm sure. Besides, dimensions don't have wars with one another. Too many things can go wrong. Julie was lovely, and I hated to leave the next morning, but it was my job. I told her, "I'm afraid I have to leave town for a bit, dear, but I'll be back very soon. Business, you know." Being a 17.08 girl, Julie had no reason to doubt me. "Make it very soon," she whispered, her lips close to my ear. So I came back, and now Krasnow has what he wants. He's delighted, as he should be. I've made up the gas for him and adjusted the formula so that it will work on people of our timeline. It's high-power stuff, and a little will go a long way. I also made up an antidote for him. This was easy, since I could work on it without feeling any compulsion to tell everybody what I was doing and why. Krasnow plans to release the truth gas just before the state convention. He'll be nominated, of course, and after November he'll be governor. With everyone else compelled to tell the truth, it should be a cinch for him. He's a patient man, honest John Krasnow is, and is willing to wait 4 years for the presidency. I ought to be happy, too. With the money Krasnow gave me, I've been living in the style to which I've always wanted to be accustomed. He has offered me a place on his staff, and somewhat superfluously, the use of his antidote. Naturally, the reason he was so magnanimous was that he doesn't want anyone else around who knows his gimmick and might have to tell the truth about it. But I have had enough of this dimension now that Krasnow has what I promised him. He's going to use it tomorrow, and if I know Honest John, and I do, not even the presidency will be big enough for him. So I'm going back to Julie. There are some obvious questions in your mind, I know, such as, why did I get the formula for Krasnow knowing there was no way for him to prosecute me while I was in Julie's dimension? And what made me come back? In short, what was in it for me? Let's call it research. Krasnow is a big-time operator. I've always been, you might say, in the peanut end of the game. He had a great deal to teach me, and I'm happy to say, was an apt pupil. You might speculate on what's in it for you, because, if you asked me, anybody who can do the side shuffle would do it before Krasnow becomes president. However, don't go to 17.08 unless you want to swap one Krasnow for another. The fact is that I've learned I can be one in Julie's dimension. After all, their formula doesn't work on me, but I can assure you that it will work on you. And that elephant story I told on my last visit is, as I've indicated, in the peanut category. All Krasnow has is a country. I'll have a whole world. There's nothing like study under a master, is there? I should be back to Julie by midnight if I start now.
The end. Subscribe for your daily stories of futures past. And now, for the next story.
A Hitch in Time by Frederick Pohl, writing as James McCree, originally published in Thrilling Wonder Stories, June 1947. Narrated by Tom Trussell. Obviously, the man was dying, and there was no chance that he ever would be discovered. I blessed the carelessness that had caused me to set the space-time dials a little off when I began this journey to the distant past. I had come to this barbaric era in the proper time, indeed, but millions of miles removed from it in space. It had been only after an annoying search that I had discovered Earth, jetted toward it in my space drive suit, and had come down out of the skies to land on this tiny deserted island in the middle of an empty sea. But it was incredible luck that had brought me there, for I had found exactly what I needed, a man who would give me information, clothing, and an identity, and then die and obliterate the record of my interference with the course of events. I, Thom Ra, walked toward him, feeble though he was. He opened his eyes and stared at me. "Thank heaven," he whispered, in the thick, hideous language of that era. "I couldn't have lasted much longer if you hadn't found me." He fell back and smiled at me with heartfelt gratitude, and for a moment I felt a wild, fleeting impulse to help him, to save his life. But of course I dared not interfere, for that would change the shape of the future, and that meant destruction for me. When I blasted off from the island, a little later, he was dead, and I was wearing his uniform and his name. He gave me information before he died, and I had no trouble locating the spot I wanted. I waited till dark before landing a few hundred yards from the war dome. Then I hid my space drive suit in a cluster of ancient trees and walked into the building that housed the most murderous weapon of all time. The sentry challenged me, of course, but I was ready for him. After a quick look at my stolen credentials, he sheathed his ray pistol. "Pass, sir," he said, and I walked in, no longer as Thom Ra, but identified as Captain San Requa of the Intelligence Service. At once I saw the atom rocket. It was on the other side of the great chamber, nestled in a wheeled cradle, ready to be rolled out to the blast-off point. Hurrying technicians swarmed about it with the last-minute checks. I walked over, saluted the officer who was supervising, and began to witness events which I had crossed so tremendous a span of years to observe. The atom rocket was a long silvery torpedo, a cluster of tubes at the rear, a snub-nosed warhead at the front. A panel in the side of it was open, and technicians were setting dials according to the figures read off by a white-haired old officer with the insignia of a general on his collar. I listened in awe and reverence, straining to note and remember everything that occurred. To think that I was actually present at the climactic moment of the legendary War of Annihilation. It was the most thrilling moment of my life. Almost I forgot to curse Master Lys and his duplicity as I watched. Almost, but not quite. For the thing was too fresh in my mind, and I was aware that I was still in danger. It had begun with a routine notice that my preparatory work had been approved, and that I was authorized to enter a theme in ortho history for my final citizenship ratings. The theme, I saw with a sinking heart, was the War of Annihilation. I had hurried to Master Lys, my instructor, sure that there was an error. "Master, you give me an impossible task," I had said. "The theme regulations are that I must make a real and complete contribution to human knowledge." "But how can I? We have so pitifully few records of the War of Annihilation. All of them had been studied and analyzed and worked over for thousands of years. There's no way for me to add to what has been written already." He cackled at me in his insufferable tri-alpha way. "There is a way," he mumbled, peeping at me out of his rheumy old eyes. It took me a moment to realize what he meant. "The time belts!" And Master Lys nodded. While I argued with him, of course. The time belts were too dangerous. Not one time traveller in 10 returned from the past, even when their projects were as recent as 100 years ago. And the farther into the past one ventured, the more certain it became that return would be impossible. For although the mechanism of the time belts could be trusted, and there was no physical menace that the conductor screens or the catenated guns could not cope with, there was the ever-present danger of fan-shaped time itself. It was the first law of chronistics. Our era is a product of everything that occurred in the past. Should anything in the past be changed, our age would also be changed. Oh, it would continue to exist, but in a parallel branch of time. And there was no way of passing from one branch to another. And if a traveller into the past should interfere in the course of events, he would be bound to the new time stream his actions created, and the unlucky traveller would never be able to return. The branches of fan-shaped time could never be retraced. The man who interfered with the space-time